Good day. Welcome to another Ransom's Weekly Wraps. I'm Viv Govender, and as usual, what we'll do is we'll go over some macro stories and end with a tech segment. In our macro stories of this week, we'll look at three things. Firstly is the implementation of the two-pot retirement system in South Africa. Then we're going to look at some jobs numbers from the US, and finally just also look at oil and what's happening in that market. Then in our tech segment, we're going to look only at Nvidia this time around. It's had a very turbulent week. In fact, in one day, it's lost more money than any company has in pure dollar terms in history. We're going to see what the future holds for this company going forward. So let's start off with the two-pot system. The two-pot retirement system basically is a new implementation, new rule set that came into place basically this week, the start of September. And what it allows is the retirement or retiree, or the pension fund holder, whatever you call him, to basically access a portion of the retirement funds before they retire. This, I think, was done to increase flexibility. You can imagine somebody in COVID, for instance, who lost their job or lost their business and might have had a multi-million rand retirement pot, but was maybe 45 and had to wait 10 years to be able to access that. That is something I think that, obviously does increase flexibility for retirees, but the other side of it is that the reason that we have the lock-in period, the reason that we have the need to lock people into only accessing the money after 55 is the fact that, many people don't really consider the future as well as they should. And in that scenario, what happens is they often spend this money too early. And then when they get to retirement age, they often are left, short of what they should be. In fact, in South Africa, the vast majority of people, we're talking about, only about 1 in 10 people, being able to actually get, a retirement that's equivalent to what their pre-retirement income was, or a lifestyle comparable to what their pre-retirement income was. 9 out of 10 people don't have that ability. So obviously there's issues in Africa where people are not saving enough for retirement. And then what happens is, of course, when you have people that are short retirement, some of them are forced to go on the government, welfare scheme, grants scheme, and that obviously is negative for the government as well going forward. On the other hand, some argue that having this extra bit of flexibility makes it easier for people to avoid or pass through significant crises, etc. If they only accessing the money for crises. I mean, you've seen jokes, I'm sure, on social media by now of people, talking about the two-pot system and the party you're going to have with one pot, etc. And I think that is a danger that we have to, keep in mind. This is just before Christmas. It's September. We're about 3-4 months away from Christmas. I think we are probably going to be finding some people accessing these funds for once off, just celebratory kind of things. It's a significant chunk of your money that you can access, or will be able to access going forward, like a third. Right now, there's not that much available because the system, of course, allows you only to access a portion of your earlier monies. But I think going forward, this could significantly weaken South Africa's retirement system, and in the long term may have more negative consequences, I think, than people have been anticipating. One more thing to discuss about this particular two-pot system is just how much money is going to be withdrawn from the system because of the new rules. I've seen estimates anywhere between 25 and 70 to 80 billion rands in the next financial year. That is, I think, something, or the next basically calendar year from now. I think that in terms of that kind of money, it's significant. I mean, 80 billion rands, if it's as much as that. Remember, there's a fixed amount you can take out at the moment, and if someone's getting 80 billion out, or the total amount is 80 billion, a lot of the smaller funds, smaller retirement funds out there are going to be affected by this a bit more than people that have large amounts put away. And I think that is also going to be the people that are more vulnerable to economic downturns going forward, and also people that are going to be more probably in need of government assistance in that scenario as well. So two-pot system out this week. On the face of it, it could be positive, but more likely than not, it's going to be negative, not just for individuals, but for the market as well, and for government as well, I think, going forward. Then, looking at the latest jobs numbers from the US, some disappointments coming through for some jobs numbers. We've seen manufacturing under pressure in the US, and we've seen the market react negatively to these things. And this is important. Why? In the stock market, there is a kind of perverse kind of incentive that happens sometimes where we like bad economic numbers because it increases the chance of rate cuts. If economic numbers are bad, rates are cut, the stock market goes up. That is the relationship that they often put forward. I do think that in this current environment, we pretty much are at a point where we know rate cuts are coming through. And in fact, if you were to look at just how much rates are likely to be cut for the next 4 meetings or so, there's a significant chance we'll have at least one rate cut of 0.5%, and not the normal 0.25%. So basically, a cut every meeting, next 4 meetings, and one of them likely to be 0.5%, not quarter. The market pretty much is pricing in rate cuts no matter what. And so when we do get bad news, it means that it's bad news without the silver lining of increasing the chance of rate cuts. And therefore, that's why we see the market react negatively to bad news at the moment. So bad news at the moment is bad news. Sometimes in the past, you'd see, for instance, troubled or weak economic numbers, job numbers coming down, or weak GDP numbers. And sometimes, paradoxically, we'll see the market go up. I think for the next little while, that's not going to be the case. I think the market right now is pretty clear that they're just going to treat bad numbers as bad numbers because there's no upside to it because the rate cuts are already going to be priced in. And then let's look at next what's happening in the oil market. We've seen oil prices come down significantly, despite the fact that we are seeing an uptick in tensions globally, despite the fact that we are seeing attacks in Russia and possible retaliation by Iran against Israel. And the reason for this is quite simple. Firstly, we are seeing demand weaken. And this is another story that kind of goes along with the bad news is bad news kind of thing we talked about a bit before. The economy at the moment is under pressure. We are seeing demand weaker, especially from China. And the demand for commodities, I think, is going to be under pressure going forward. We've seen some numbers from China indicating that commodities are starting to pile up, at warehouses, etc. in China, and indicating that the country is not absorbing the same level of commodities that they were in the past. And I pick China here because it's been the delta, it's been the thing that's been changing, or responsible for the most change, the most increase in commodity demand of any country out there. And I do think that what's happening there right now is going to have a downward effect on global growth and global commodity demand going forward. That's not to say that they're the only part of weakness. I mean, we've seen weak numbers from Germany recently in terms of what's happening to that economy. And obviously, we mentioned what's happening with the US jobs market as well. And so, yeah, we've seen, for instance, oil prices significantly below $80 a barrel for Brent crude in an environment in which we are seeing, difficulties in some places in the world that are historically very important for oil production. And I think, like I said, this is a case of demand, not a case of supply. Okay. And then just moving on to Nvidia. Now, Nvidia had one of the worst days of any company in pure dollar falls in history. I think not the worst day ever. To give you an idea of how big the fall was, it fell by about 9% in one day. And given the fact that it's a $3 trillion company, a 9% fall is like, $270 billion, an amount that makes it a bigger loss that day than the value of like McDonald's or Pepsi. There's only about under 30 companies listed that are worth more than about $300 billion. And Nvidia lost that in one day. Now, why is this? Well, there's a couple of things here to look at. First of all, people are wondering whether or not the weak economic demand we are seeing, the weak economic numbers we are seeing, indicates that the overall economy in the US is weak. And that means that some of the spending that people have been talking about that's eventually going to go to Nvidia may not materialize. Now, that is obviously a concern. Nvidia is not gone crazy in terms of valuations because it's grown its earnings so much. It's kind of kept up with the growth in share price. However, the spending that's required to maintain this kind of valuation is incredibly high. And if we are seeing a weaker economy globally, maybe places like Facebook, Microsoft, etc., will not spend the money they were planning on spending on Nvidia chips, and that would obviously be negative for the company as well. And that would be one thing. The second thing, there was a rumor that went around that apparently they're under investigation by the Department of Justice for anti-competitive or monopolistic behavior. Nvidia has thus far denied that they have gotten any letter from the US government about this. But I wouldn't be surprised if that does occur. I mean, Nvidia makes a huge amount of money. It's obviously dominant in the sector, has seen a huge increase in pricing. And in that environment, it kind of makes sense that the government will look at you. I personally don't think that there's a strong case to be made that they are behaving monopolistically, unless they're doing things like tag up TSMC's production unfairly. So those were the two things that really affected Nvidia. I personally think that the antitrust stuff is less important, but the economic stuff might be more important going forward. That's it for this week. Thanks for joining me. Cheers.